Running a small business in the United States is not easy. Every day, business owners juggle responsibilities like managing employees, serving customers, controlling expenses, and planning for growth. In the middle of all this, insurance often feels like something you set and forget. You buy a policy, you pay your premium, and you assume that if something goes wrong, your insurance will take care of it. But that assumption is exactly where many small business owners make their biggest mistake. Insurance is not just about having a policy. It is about understanding it, maintaining it, and using it correctly. A surprising number of small businesses in the US face denied claims, delayed payments, or massive out-of-pocket losses, not because they were uninsured, but because they made simple insurance errors. In this video, we are going to talk about the top 3 insurance errors US small businesses make. These are not rare mistakes. They happen every day to real business owners, restaurants, retail stores, contractors, online businesses, and service providers. These errors can quietly cost thousands of dollars. Sometimes, they can even force a business to shut down. The goal of this video is simple: to help you recognize these mistakes before they hurt your business, and to show you how to avoid them in a practical, realistic way. The first and most common insurance error small businesses make is assuming they understand their policy, when in reality, they do not. Many business owners believe that once they purchase insurance, they are fully protected. They assume coverage is broad, automatic, and all-inclusive. Unfortunately, insurance does not work that way. Every insurance policy has specific coverages, specific limits, and specific exclusions. If you do not understand these details, you may discover the truth only when it is too late, right after a loss occurs. Why this mistake happens? This mistake happens for a few main reasons. First, insurance policies are written in complex language. Terms like actual cash value, replacement cost, endorsements, exclusions, and deductibles are not always explained clearly when a policy is purchased. Second, many business owners are busy. They trust the agent, sign the documents, and move on without reviewing the policy carefully. Third, some businesses grow or change, but the insurance policy stays the same. New equipment, new services, new locations, or online sales may not be covered under an old policy. Real-world example: imagine a small retail business that suffers a fire. The owner assumes insurance will replace all damaged inventory at full value. But when the claim is processed, the payout is far lower than expected. Why? Because the policy was based on actual cash value, not replacement cost. Depreciation was applied. The business owner never realized the difference. That single misunderstanding results in thousands of dollars of loss. How to avoid this error? To avoid this mistake, read your policy carefully, even if it feels overwhelming. Ask your agent to explain coverage in simple language. Identify exclusions clearly. Understand your coverage limits and deductibles. Review your policy at least once a year. Update coverage when your business changes. Insurance should never be a mystery. If you do not understand what is covered, you are taking a risk you may not even realize. The second major insurance error small businesses make is delaying the claim process. Many business owners hesitate to report an incident right away. Some hope the damage will be minor. Others want to wait and see. Some are simply unsure whether the situation qualifies as a claim. This delay can be extremely costly. Why timing matters in insurance. Insurance policies include strict reporting requirements. If you do not report a loss within the required time frame, the insurer may delay the claim, reduce the payout, or deny the claim completely, even if the damage is legitimate. Insurance companies expect prompt notifications so they can investigate while evidence is fresh. Why business owners delay. Fear of premium increases. Uncertainty about coverage. Wanting to avoid paperwork. Assuming small damage is not worth reporting. Unfortunately, small problems can grow into major losses. Real-world example. A small business experiences water damage from a leaking pipe. The owner cleans up and continues operating. 2 weeks later, mold begins to appear. When the claim is finally reported, the insurance company questions why the damage was not reported immediately. The delay becomes a reason to deny part of the claim. How to avoid this error. To protect your business, report incidents immediately, even if damage seems small. Document the situation with photos and notes. Follow your insurer's reporting instructions. Keep copies of all communications. You can always withdraw a claim later, but you cannot go back in time to report it on time. The third major insurance error is failing to keep proper records. Insurance claims are built on documentation. If you cannot prove ownership, value, or condition, your claim becomes weak. Why documentation is critical. Insurance companies rely on evidence to verify claims. Without documentation, they cannot confirm what was damaged, how much it was worth, when it was purchased, how it was used. Even honest claims can be denied if proof is missing. Common record-keeping mistakes. Lost receipts. No inventory lists. No photos of equipment. No maintenance records. No written incident reports. Many small businesses keep records casually, until they need them. Real-world example. A small construction business loses expensive tools due to theft. The owner knows what was stolen, but cannot provide receipts or serial numbers. The insurer reimburses only a fraction of the loss. Another example. A restaurant suffers equipment damage. Without maintenance records, the insurer argues the damage was due to wear and tear, not a covered event. How to avoid this error? Strong documentation habits include keeping digital copies of receipts, photographing major equipment, maintaining inventory lists, backing up records in cloud storage, logging incidents immediately. Good records turn insurance from a risk into a reliable safety net. What makes these errors especially dangerous is that they are silent. You may not realize you made them until a claim is denied, a payout is reduced, or your business suffers financial strain. Insurance mistakes do not usually hurt right away. They hurt when you need help the most. Insurance should protect your business, not surprise you. By avoiding these three errors: not understanding your coverage, delaying claim reporting, failing to keep records, you greatly increase your chances of successful claims and financial stability. A little preparation today can save your business tomorrow. If you are a U.S. small business owner, education is your strongest protection. Understanding how insurance really works helps you avoid losses that could otherwise change your future. Stay informed, stay prepared, and always treat insurance as an active part of your business strategy, not just a monthly expense.